Welcome to the MHP Exchange podcast, where industry veterans Frank Rizzo and Eric Busadil generously share their wealth of knowledge in their new podcast dedicated to the manufactured housing space. They tackle tough questions to provide valuable insights for those considering investments in mobile home parks. If you're seeking answers in the manufactured housing space, this podcast is your go-to resource.
Welcome back to the MHP Exchange. Frank Rizzo here. I want to talk about how to thrive today in a high interest rate environment with your mobile home park investments. And we're going to talk about 3 actionable items that you can take to thrive in your investment cycle right now. But before we get started, if you find value from this program, I ask you to do one favor. Like this program and rate this program on the platform that you're listening to. That helps us get out to more people and share what we know about the MHP space. So let's get started and let's talk about how to thrive in the high interest rate environment that we find ourselves in. And let's get started with talking about the challenge of even putting a deal together. And the big challenge is that sellers are anchored to prices that just might not exist anymore because the rates have changed. You know, when rates go up, it just makes the cost of money go up. We know that, and it makes it makes it more challenging to make some of these deals pencil out when the seller is anchored to a price that might have existed or they might have heard of when rates were at 4.5%. So how do we deal with that? How do we overcome that? Because we still want to, find opportunities. We're still looking for the next MHP deal. We still want to grow the portfolio. So how do we overcome that? And this is part of the strategy of looking at, these deals as either being transactional or relationship based. When you're having a transactional based, it's simply about price, right? It's simply about seller has a number, let's hit that number, let's move on. And when the cost of money is 3%, 4%, that's easy to do. But now that the cost of money is higher, when you have that, when we have those conversations with sellers, I want to get to the root cause of what's most important to that seller. Is it the surety of closing? Is it closing with somebody who has a track record and a book of business of closing in this asset class, right? Who's not going to be concerned when they start peeling back the onion and they see the things that they're going to see that you're going to find inside of doing the diligence in a mobile home park? Or is it, and can they work with us on terms? And what do I mean by that? Are they willing to work with us on some seller financing or some seller participation where they're becoming almost a partner in that project, in that project's success? So in doing that, we've been, I think, extremely intentional over the last 24 months of sharing with the sellers that we've engaged with, our underwriting, letting them know based off of the numbers that they're providing and based off of our business plan, how those numbers look. Because quite frankly, a real seller understands that, you're not making that investment to lose money, right? You're making that investment in that community because you'd like to see that generate a certain rate of return. So having a real seller where you can have that conversation with, you can come up with some solutions to getting to the desired result. I mean, the sellers out there on the market because they don't want to own and operate the property anymore. And we're out there looking to buy because we're looking to expand the platform. We're looking for other opportunities where we could add value to that community and add value for, our partners in our platform and grow wealth. So how do we do that? And in sharing our underwriting, we've been able to get seller participation in a number of our deals, especially recently. For instance, we had a deal that closed recently where the seller was anchored at a much higher number. And he had to go through a couple of iterations of deals not working, deals didn't work for one purchaser, deal didn't work for a second purchaser. Finally, when they met us at a price, we realized for this to work, we needed for us to hit the number that he was looking for. What we needed from the seller was some seller financing, and we needed seller financing at a rate that was below market, quite frankly. If we went to the bank, it's at 7%. We needed the rate to be lower, right? We needed the rate to be, at 4% for us to work for us. For the seller realized that 4%, he might not be keeping up with the rate of inflation. So he needed a higher rate. And for us to meet at some sort of middle ground, we got a number that was less than, obviously he wanted to keep the rate higher. We wanted to keep it lower. We met at a middle ground, but we were able to defer some of that cash flow because he didn't need all the cash flow now, but he deferred that cash flow to a refinance, 40 months into the future. So it gives us the time to execute on the business plan, to create some value in that community. He'll get his money, at a refinance, and he's a participant, quite frankly, in our execution. So he realized that our business plan required that cash flow. We needed to make sure that we were hitting certain metrics for our investment. But he also realized that in doing so and in partnering with us to get it done, he didn't have to worry about the operational, day-to-day of the property. So that only occurred because we didn't look at it as a transaction. We looked at it as a relationship with the seller, and we were able to show him what we intended to do. And by lifting up the veil a little bit, it gave us the opportunity to move forward with that type of creative structure to get the deal done. So that's the first actionable step. Make sure that you have your underwriting available and educate the seller on what you're looking at, and what his numbers mean to the business plan on the ground. The second thing that we've done is we've looked at ways to increase operational efficiencies by accelerating some time-sensitive tasks. And let me give you a very specific, for instance. Typically, when we acquire a property, we would get updated data on all the residents. So we buy a park, we know that we have 60 residents there. We've had their original applications or their leases. In some cases, they're old. In some cases, they're missing a lot of that data. And what we had done historically is we would close on the property. We would send out our new community rules. We would have a new application to get all that data in-house. Now, I will tell you historically, it would take weeks of man hours of chasing people down because you're a new owner. The residents don't feel a necessity to get this done. They're already there. They don't feel the need to pull out the application, and we would get it done, but it would take 6 to 7 weeks to get done. What we realized is that the resident would be more likely to do that for the current owner or the former owner rather than us being the new owner. We don't have that relationship built on trust or that time frame. And so we've moved that up in our time frame, and we've made that almost a condition of closing where we've worked with the current owner to get that updated data for us. Now, what does that do? We realize there's certain things we can't change, right? Contractors are going to come when they come. The price of materials are the price of materials. But one of the things we could change is how we accelerated some of the timelines in the work that we were doing. And those time-sensitive tasks, if we could move them up and save time once we owned the community, that's adding efficiency and allowing us to reallocate that time somewhere else. That's allowing us to move forward in the business plan. So the second thing I would remind people to do is when you're buying a community or you're getting ready to close on your community is to see where you could move things up. If you can't make up, if you don't have that cost of capital is higher, anything you do to save time will help your return. So always look at your process. Always look at ways of creating that efficiencies inside that process, and you'll be able to hit the numbers that you need to hit for yourself, for the metrics that you have internally, or for the metrics that you have for other investors who are partnering with you. And the last tip that I'll give you to deal with or to succeed in these high interest rate environment times is that you have to pursue a deeper value add scenario. I come, being in real estate for over 25 years and having, a background really in investment sales. And I think a lot of, people probably started out, I started out with, doing house flips and then dealing with people who wanted to do house flips. And then I would talk to potential investors. And when you ask them the type of work they wanted to do, it essentially equated to buying a house, throwing throwing some paint on it, and then maybe putting it back on the market. Those days of being a quote unquote light value added investor in this environment is very tough and challenging. You have to look at maybe some deeper value add situations, because when you can buy at a lower basis, you can offset some of that higher interest in that value appreciation that you're creating. So, when we looked at where the market was heading, we kind of reshuffled the deck a little bit. We realized that there were some assets that we bought that we were seeing numbers that if there was a correction in the market, we might not see again. And we looked at some projects that were a little bit deeper value add, maybe a little bit more infill, maybe a little bit more infrastructure work, right? But because it fell out of that bucket of 70 to 80% physical occupancy, or maybe there was a little bit more vacancy in that community, we were able to buy it at a little bit more of a discount, right? And in some cases, a much more significant discount. And that strategy allows you to create that value appreciation or force that value appreciation, and it discounts significantly the interest rate environment, because you're not you realize that you're going to create that value in the infill, in that additional work that you're doing. So that one's not for the faint of heart. I mean, you've got to dig in deep to do that. But we found, and if you search, there are still opportunities like that available. But one thing that I would stress, make sure you're in the right market for that, right? You don't want to do a heavy infill project in a county with, 20,000 people and the economy is slightly declining, right? You want to be in a strong county. You want to be in a market where you see a growing economy and that you see there's a divergence of median house sales and where you're looking to sell homes or you could bring homes in. I mean, we typically like to be in markets where the median home sale price is over $200,000, where we know if we bring in a brand new home and we're offering that home out between 60 and 70,000, there is a huge savings for the consumer, and the alternative choice will give us some great opportunity and prospects to fill in that community. So the 3 steps that I'm going to give you here today is: 1, make sure that you're making your seller a partner with you. You're sharing your underwriting and you're getting you can get creative. If the seller's anchored to a price, make sure that he can meet you on those terms. He or she can meet you on terms that make that deal work. And you're only going to get there if you share the underwriting and what that deal looks like underneath the hood, right? And what that's going to look like if anybody's going to operate it. You'll save them time. You'll save them a lot of energy going from deals that never are going to pencil out. And you could prove yourself to be a worthwhile partner to get that deal to the finish line. Number 2, look for efficiencies in your process. And you constantly have to be reviewing your process and see where you could move things up and how you could save time to get your business plan executed. That's a very key component to operating and succeeding in this environment. And then lastly is look at some deeper value add opportunities or scenarios, that might have a little bit more infill, that might require a little bit more work, because those opportunities you can find at a deeper discount And that deeper discount offsets the higher interest rates. So those are 3 strategies for you. If you want more information on this or you have questions about this strategy, click the link below. I'm happy to answer your questions. Who knows? Maybe it'll turn into our next podcast on the MHP Exchange. Until next time, everyone, happy investing.